Hey, what's going on, everyone? My name is Zach here at the Divine Dividend, and it has been a while since you've seen my face. All right, I probably look the exact same, but I just want to say that I'm back. I'm more excited than ever to get back into making money, showing you guys how to make money, and just how to manage your portfolios and kind of just grow along with you guys. All right, I mean, I don't even really know what to say. To be honest with you, life just got a little busy. You guys know how it goes. I'm sorry if you guys have been looking forward to some content, but I'm here to pay it back for you, all right? So I think it's actually fitting that I'm going with this video instead of anything else, because when you do get busy, you don't really have time to make that perfect trade. You don't have time to get in, get out when you want to. And that's what this video really is for, is if you had just bought these stocks exactly 2 years ago, all right, you just got in on a random day. For the example over this is for July 22nd, but you just threw however much money, and for the example I'm saying it's $5,000 into each of these stocks. So you invested $10,000 2 years ago, and I didn't even pick the two best ones. All right, I picked two dividend aristocrats, which are notoriously safe and less volatile, not growth based at all. They just have dividends, and their dividends been growing for 20, 30 years, depending on which scale you use, at the minimum. But we're going to talk about Coca-Cola and AbbVie, and just what putting $5,000 in each of these 2 years ago to the day almost would have done for you. And with this thinking in mind, it literally does take no effort. Like, you, on one day, you just bought two things at the same time, and then you didn't look at it for 2 years. So let's see where we turned out. All right, so sit back, relax, and let's get into it. All right, so this is just a chart of the SPX, right? Just a chart of the S&P 500. And I'm going to say this, and you can't convince me otherwise. The stock market is rigged to go up, all right? And there's a ton of different factors. Obviously inflation, just more total debt, just there's more money around the world. And countries from around the world, so not just the US, that are investing in these S&P 500 companies. But if you are investing in them, like, the evidence speaks for itself. Like, these companies, like, this index is just going up exponentially. Like, this is crazy. This is from so we had the crash of 2020, right? But then look at how ridiculous this jump is. So it's rigged to go up. So I'm saying that instead of timing the perfect trade, it's just getting in and staying in. And especially if you're in stocks that have, or companies rather, that offer a dividend, that's only going to help amplify your growth, even though the companies you're in are not necessarily growth based. All right, so what I did here was pick two stocks off the dividend aristocrat list, because obviously I'm obsessed with dividends. But dividend aristocrats, they have their own criteria depending on which website or kind of fund or firm you look at that distinguishes these. But essentially, they've been around for decades. They have been paying dividends. They don't miss payments, whether they're monthly or quarterly. And not only that, their dividend grows year over year. So it's a pretty exclusive list, I guess, to be a dividend aristocrat. But that's the thing. So most of the companies on that list have a dividend between like 2 and 6 or 7%. As soon as you start finding a dividend that's over 7%, it becomes a little unstable, and it's harder to grow your dividend year over year when you're already at 7%. That's a lot of cash flow that you're paying out to your investors. So either way, so we're looking at Coca-Cola and AbbVie, all right? Coca-Cola, I have this chart going back to somewhere around here, June 2016. Just so you can see how much more the growth would have been had you got in earlier. But for this example, we're looking at July 22nd, 2019. So like I said, this is a buy and forget method. This is 100% meant for like the busy person, or the person who has the extra money on the side and doesn't necessarily know what to do with it. You put it in a safe, stable company, especially something with a dividend. 99% of brokerages or exchanges have the automatic drip filter, the dividend reinvestment plan. So you get a company, and then they have a dividend. It automatically reinvests the dividend, and it just ultimately gets you more shares. So the next quarter, the next month, whenever they pay a dividend, you're getting a bigger payment, and so on and so on. It just kind of compounds on top of each other. So for Coca-Cola, at least for example, like 2016, if you were buying shares for $42, it's obviously more impressive than if you're buying shares here July 22nd, 2019, when you're buying them for, something like $54, right? But for the example, that's what we're using, okay? So this is our entry point here for Coca-Cola. AbbVie, same story. They're going to have peaks and valleys, of course. But 2016, you could have been buying shares somewhere around like $54 for this. And today we're at $117. So, it's crazy. But if you happen to get in here, just looking at, like I said, July 22nd, the entry is about 67, 68 bucks, somewhere around there. So, like I said, we've seen crashes here. We had, the pandemic happened right around here. All companies are going to have ups and downs. So a 2-year span is enough to see, its different cycles and, just generally what happens in the lifetime of a stock and the life cycle that it has. All right, so real basic chart here, but this is going to illustrate it perfectly, okay? So for the example, I'm talking about $10,000 total invested, $5,000 into each company. So, you're somewhere on the spectrum, right? You're either investing, maybe like $100, maybe you're investing 20 grand or more. Okay, so I picked 10,000 as a nice even number. Either it's something for you to strive for, or something you can scale up depending on how much money you actually have invested. So July 22nd, 2019, Coca-Cola, somewhere on that candle we saw for that day, maybe your entry is $51.22. And for AbbVie, $68 respectively. All right, so $5,000 at 51 bucks a share. Going to get you just under 100, and for AbbVie at $68 a share, $5,000 going to get you 73 and a half shares. Okay, so we fast forward 2 years. July 17th today, 2021. You can see that the price has gone up for both of them. Okay, so obviously, like I said, stock market is rigged to go up. The share prices is going to go up for each one. So whatever percent that growth is, tack that on to the percent growth that you're getting from, or the dividend return from each stock. So like I said, somewhere between 2, 6, or 7%. We'll call these ones, 3, 4, 5%. You're gonna go up, all right? So after the drip, you went from 97.62 shares, you went up to 104.07 shares, all right? So you gained 7 shares, 6.5 shares, by literally from doing nothing. You just click the box that said, automatic drip, reinvest, boom, 7 more shares. Same thing with AbbVie, all right? You just click the button, like literally says, do you want to set up automatic drip? Yes, I do. Boom, you went from 73 shares to 81.4 shares. All right, so that growth right here, this difference is a little bit higher, which means AbbVie is going to have a slightly higher dividend. That's what that means. But if we started at $5,000 off each one, just going off the price alone, it's obviously going up $5 per share here, $50 a share here. And not to mention you have more shares because you were dripping all of your dividends. So at the end of the day, at the end of like 700 and some change days, 2 years later, you went up a total of $5,438. That's a 54% return. All right, just for a little bit of context, 54%, right? This is sort of the benchmark, I guess, for why people give their money to hedge funds or they give them to portfolio managers. All they really want you to do is beat the S&P 500 or the stock market in general, okay? Because what they're doing is they're picking individual stocks, and you're giving them their money, and they're making obviously more money for you, hopefully, than what you would have bought from just buying a couple of random stocks anyway. And just buying 1 share of Amazon, 1 share of Microsoft, 1 share of Apple. Those have been great returning stocks. However, you never know if you're going to get it in a good time or a bad time. So, over the course of the last 10 years, let's just take a look at what Business Insider has to say. All right, the average 10-year stock market return is 9.2%. The S&P 500, so the ones we were looking at earlier, are going up about 13.6%. All right, so I picked 2 dividend aristocrats, 2 companies that are not growth-based inherently. All right, they do grow. That's just because they have a great business model and because they have been around for so long. It's a household name, but you're crushing it. We got 54% over 2 years, so divide by 2, 27% annually. You doubled the S&P 500, all right? So if you're doubling the S&P 500, you are literally crushing it. You are killing the game. You are doing big things, and that's all you can ask for. So instead of necessarily paying someone to do this for you, just go out there, do a little bit of research, find good companies that are doing this, that are growing, that have a dividend. Their dividend grows. They don't miss dividend payments. And just watch yourself grow. You don't need to pay someone. You don't need to do tons of research. Just dividend aristocrat, keywords, all right, Google it, you'll find a list of like 50 or 60 companies. Take a look at a couple of the ones you've heard of. Just find out which ones are, happen to be growing, even though they're not growth stocks. And this is what'll happen. All right, 27% annually over the last 2 years. Phenomenal. All right, real quick, because I want to keep this video short-ish. I literally just Googled dividend aristocrats, right? Shows you all these companies that are on there. It's a decently long list. But if we look at the top, look, AbbVie right there. Oh, Coca-Cola right there. Colgate, Dover, AT&T, Aflac. Like, these are all household names. That's why they've been around for so long. They've been paying dividends. They don't miss their dividends. They grow their dividends. Johnson & Johnson, McDonald's, Lowe's, like all the Pepsi, like so many companies you've heard of, and you didn't realize that they were so stable. And they're not going anywhere. Like, these companies have been around for decades. They're going to be around for more decades. And like I said, this is an exclusive list. They're going to try to stay on here. So they're going to keep growing their dividend. They're going to keep making their payments, which in turn is just going to make you and I both money. Lastly, you can just check this out, dividendchannel.com. It's actually a really good website. This is where I just got all the information for today. You can pick a certain day, and it will actually tell you. So if we look at AbbVie, for example, if you did 10K, it'll tell you your starting shares, your ending shares, and it'll just give you all these numbers for you. So you don't even really have to crunch the numbers. It'll do it for you. So that's about all I got for you guys today. Actually, let me show you one more cool thing. All right. So real quick, if we ended up with 104 shares of Coca-Cola, all right, your Coca-Cola payment would be $43.68 in dividends for this quarter. So every 3 months you're getting that. In fact, you're actually going to get more. So this is saying you only have 104 shares because you're actually getting more money. So you might be at 104.5 or 105 shares. And every quarter it's just going to go up because you're dripping your dividends, like you're automatically reinvesting them. So it says these payments are the same, but if you reinvest it, this is actually going to be more, so on and so forth, up until you're getting, a full share or more every quarter. So $43 for Coca-Cola, $105 every 3 months for AbbVie. So, that's like $150 for doing nothing. And then times 4, because there's 4 quarters in a year, 150 times 4 is $600 a year extra just for having these, not to mention the prices going up. So take it if you want. I hope you guys enjoyed this video. I hope you guys enjoyed me being back. I'll be sure to get some more videos out there. I hope you guys have a great night, and I'll see you later.